Hello, traders. Good evening. Welcome to this session today where we're speaking about position sizing, or calculating your positions before you enter your trades. I hope you've had a successful trading day today. We had some events coming up from the US. There were some movements that came up. Hope you were able to take advantage of them. Sam, how are you?
Hey, Mathew, I'm good.
Yeah, I'm well. How was it on your side with the PPI coming up?
Today was interesting. We had PPI. The market did appear to react to it, but then even earlier in the morning, we had the BOJ coming in with the news that they'll maintain the yield curve, the YCC yield curve control, and that basically sent the USD JPY was basically in an upward trend for the better part of the morning. So that was some positive reactions in the market in terms of volatility for traders who are looking to trade volatility. And then for PPI, it was, I don't think the reaction lasted, but it did give a sizable chunk. So that was a bigger part of what happened today. It was fairly better than Monday and Tuesday, where it was a bit dull in terms of activity in the market.
Sure. There was quite a small move. Wasn't bad. For scalpers, they were able to get something out of it.
Exactly.
but if you're expecting a big move, I mean, it didn't come up until later when, of course, a reverse move came up, because it's like everything was priced in as from the beginning.
Yeah. So markets moved in one direction and then erased all that movement after some time. Yeah.
Okay. And by the way, in line with the events now and the volatility which comes up with the news, this one brings us to the position sizing. During times of volatility, during times of low volatility, but specifically for the times of high volatility or high market movements when there is news, how should you place, or what positions should you take in the markets? Or rather, should you take a bigger lot size or a lower lot size, considering the volatility which is coming up and the risk?
I think as you're about to see, whenever you're calculating your positions, you always factor in the average movement in the market. That's going to be a factor. Where you're going to set your stop loss is always dependent on what the market is currently doing, and naturally that should be in line with the current volatility. So if there is a need for a very wide stop, then naturally you'd want to use a lower or a smaller lot size than what you'd normally use. So it's still a function of volatility at the end of the day. When it's high volatility, use smaller positions. When it's low volatility, of course, you can now increase your positions. But then you're going to see how you're going to do that.
Yeah, sure. But in one or another, there are traders who do the opposite. They want to take a very big lot size, hoping that big move is going to be a big rip or a big profit.
Exactly.
But then it turns out there is no getting rich quick. Now it's about waiting.
Okay. So you generally, I think you
it's better to have smaller returns over and over, and especially when there's high volatility. Just a small lot size is able to generate. It's able to generate as much profit as it would be a big lot size in times of low volatility.
Exactly.
Okay, and now here we have position sizing. What is position sizing? It's simply, in very clear language, just setting the correct amount of units, that is the lot size that you want to enter in your sell or buy order. How many lots? Just like that. And
I think basically that's it. And then there are steps that you need to go through. When you trade a single asset or currency pair or commodity for some time, then these things become repetitive, and you can can make a rough estimate of what lot size you should be using. But when you're starting out, then you need to go through a process to determine what lot size should I be entering various positions. So that's why you have a process. The first one being defining your risk. I think this one is standard across all the assets you'll be trading. So defining risk, I think we can go to that slide.
Yeah, so basically, as we're moving to the slides, just need to know how much risk you're taking. You define the risk, then determine the PIP value, because that one is going to is going to help you understand the movement that you're expecting, how much loss it's going to be, and it has to be up to the maximum risk that you've defined. Then how many stop loss pips do you have? Then you calculate the position. So on our next slide.
Yeah, so basically, there's this interesting clip I was watching on one of his traders who was saying that you can increase your risk if you're in profit. I think that's a concept you did yesterday, the other day, of scaling in and scaling out.
Yep.
Yeah, so I think it was George Soros who was talking about it. If you're already in profit, then maybe your risk tolerance can be slightly bigger. But in general, traders need to know how much they're willing to tolerate in the event of a loss. And this is called a risk tolerance degree. So you generally have three types of traders. You have an aggressive investor or a trader who has a high risk tolerance. They're
high risk appetite.
Exactly. They're willing to take they're willing to put larger chunks of their capital on the line so that they can get potentially better results for that risk. And then we have moderate who don't want to be risking too much or don't want to lose too much for their trades. And then you have the very conservative traders who usually have very small, either very tight stop losses or very small risk rewards. Very small risk percentages when it comes to trying to allocate how much they're going to risk per trade. So you need to know generally where you lie in between. And a good rule of thumb is for conservative traders, people who generally risk 1%, 2% or lower of their capital, you consider that being a conservative, and that's usually, I think, a good rule of thumb. And then for moderate, anything above 2 going to 5, 6, 7%, you're probably in the moderate category of risk takers.
That's great. And now that you've talked about risk tolerance or risk appetite, do you think it's standard across traders, and which one is better? Because you see, there are those that are thrilled by high risk amounts, but again, they are expecting very high returns. Yeah. I always have a challenge discussing that, and what we finally realize that if you are very aggressive, then you catch the trade or the entry early. Yeah. If you're conservative, you catch it a little bit later, but you don't have, you're not exposed to that risk of getting into losses. Yeah. So
because it depends. That's why you need to. Risk tolerance is a personal conversation. So you'd have someone who at any one point can be risking something that you'd consider a very huge amount. And to them, it's probably moderate to low risk because they have that money and they're willing to put it on the line for that. So it's usually a very personal conversation, because most of the times it's an opportunity cost with what you can do with that money with other things. So if that opportunity cost is low, then, or if you've already settled with the terms that this is money for maybe trading or investing, then you might be more comfortable moving higher up, maybe being a moderate risk taker or an aggressive risk taker. But in most cases, I think just being conservative and then trying to build slowly is usually very consistent and helps you manage your emotions more.
Sure, just spot on. But again, even if someone has got very high, we still be putting a little bit of control there, because even if you've got a very high risk tolerance or high risk appetite, again, you want to cap at some point, maybe not at the recommended 2% for the conservatives, but let's say, for example, maybe 5%, anything bigger than that, even if you have a very high risk appetite, at some point, you might get tired of it.
Yeah, and also I've seen some traders, when they've made some profits, then they're able to increase their risk tolerance, because now they're putting profits and not the core principle on the line.
Sure. And so one very important thing is determining the PIP value. How much money are you able to earn when with a small change in the value, or the small change in price? That is a PIP. And that's when it's going to help the trader know, if I set a 20 pips stop loss, then how much money is that? Yeah.
So to calculate the PIP value, you simply multiply a PIP by the lot size. And in this case, you're assuming it's a currency quoted in dollars, where the quote currency is dollars. So for example, if I'm doing a mini lot, that means I'm buying 10,000 units. And from the definition of a PIP, it's 0.0001. So now you'll end up with a PIP value of $1. That means for every increment, for every increase by 1 pip, I'm making $1 or losing $1. If, for example, I'm in a short position. So that first of all gives you a good way to measure various distances in the market, because you can always use your crosshair on your MT5 platform to measure the number of pips. So once you can determine your pip value, and you know your risk in terms of the dollar amount, then at least you're heading somewhere in terms of determining your position size.
Sure. This is very important for someone to learn the actual arithmetic which goes into it. But nowadays things are simpler. Even with our FX Pesa platform, there is a position size calculator, and actually our newest application, Equity Trader app, you can find the position size calculator. You don't have to struggle a lot, but it's always good that traders understand the arithmetic behind it. Yeah.
Exactly. For those who are wondering, we have the new application, I think. So it's gone live. You can try it out. We have an inbuilt position size calculator, and that's something you can use while you're at it.
I mean, it's an app that you're able to keep updated on the level of risk by there, because you see where is your equity as compared to the loss which you're making. You just keep on checking all along where it is. There is a graphic kind of that shows you how your equity is getting eroded all along. So that's a very great feature. I think one day we might want to review how the app works. Yeah, that would be good, Sam. That should form one of our webinars. Huh?
Yeah, I think that would be a good discussion to go around, because it simplifies a lot of things.
If you have a trade and then your capital is getting eroded, it just actually changes the color codes, where if it just starts getting towards the red, then you realize that you need to maybe add your capital or something like that. So it's also an enhancement in the risk management for a trader. So in this case, determine the PIP value, then
so
you go to the stop loss.
On the previous slide, as a standard rule of thumb, if the currency if the quote currency is dollar, then you know your PIP value is always 10 for a standard lot of 400,000 units.
Yep. Yeah. Okay. But again, it changes with different currency pairs or different assets.
Yeah. So now, for example, in this case, if my quote currency was maybe Japanese yen, so my PIP value of 1 will be 1 Japanese yen. So I'll have to convert it to dollars,
the base
using
currency,
the
which is
current
dollars.
market. Using the current market rate. So I'll have to multiply this by the current market rate.
Sure.
Or divide it rather. Yeah.
All right. So determine the stop loss in pips. And then once you determine, then of course you know where to place it. You find the difference between your entry and then the stop loss area. You find the number of pips.
Yeah.
Just as simple as that. Then you want to know the amount multiplied by the pip value.
Yeah.
As easy as that.
So your pips is simply the second last digit in any quote, not only currency quote. So it gives you a good estimate, because if it's 5 digits, 5 decimals, then you know it's the 4th decimal. If it's 3 decimals, you know it's the second, which is still the second last. So, for example, in this case, if we have someone or a trader attempting to enter at 1.081110 or 110, then your pips, if you've already determined where you are going to exit in the event of a loss, you can simply subtract those two to get your 0.004, and that's simply 4 pips, because it's an increment of 4 steps downwards.
Yeah, sure. So how to calculate? So you have the lot size, you have the pip value, and you have the number of pips. So then you have to do just multiply the pip value and with the number of pips, and then you're able to find that dollar amount. Once you find the dollar amount, then you're going to divide the amount of money which you are risking by that dollar amount, and then you get the estimate of the lot size. Yeah.
So it's very straightforward.
Mm-hmm.
Instead of I think the position size calculator can really help to do a lot of this but it's good to understand the arithmetic behind it, as you said.
Yeah, but I think when it comes to the lot size, actually the position size calculator, you cannot actually know the amount of lots that you can it cannot help you estimate with the dollar value or the risk amount and the pip value and the distance where you're having pip value and the pips, or the stop loss distance. Simply the pip value multiplied by the pips is the stop loss distance. The dollar value is the risk amount. So there is not, we don't have that provision, but again is where you can just put a 0.01 and then you see what is it giving you. 0.02, what's it giving you? For example, is that amount which you're getting within your risk figure, and then you can get along. So this is very important. This formula is very important. Just take the risk amount, which is the dollar value, divided by the stop loss pips. The pips, the value of the distance between the stop loss and where you're entering your trade, and then it's going to give you, you divide that, it's going to give you the lot size.
Yeah, so after 1 or 2 trades, on average, you'll know what lot size you should be using. So it's only when you're starting out trading a certain pair that you wouldn't be aware. So you might want to run this calculation only once or twice. To make this one a little bit clear, let me just use a pen to highlight so it becomes very clear. This $10, this is the amount of risk that you're taking. That's for example where you had or you're risking 2%, or you're risking, let's say you're risking 10%. So and you had $100 amount. So then how you're deriving this, it is where you're having like 10 over 100, which is your account value, then multiplied by that is a 10% multiplied by 100. 10% is 10 over 100, and this one is going to give you around $10. So this one can be anything depending with how much money you have. If, for example, this amount here was $80 in your account, this would be is it $8? It would be equal to $8. And that's what you have here. So this 40 that you're talking about is when you're looking at your charts, for example, and this is where you're getting an entry to sell at this point, and you'll be putting your stop loss at this area. So the stop loss distance, if you have your entry at that area, is where you're taking this distance from here to here. And this is where you're converting now this number of pips, the number of pips
multiplied by the PEEP value.
Yeah.
I think this one will summarize it properly. PEEP value. So this one is going to give this
So
stop loss
assuming
distance.
Yeah, assuming it was a standard lot, then
Yep.
that would have been $40. But
Yeah,
then
sure.
you want to, if one lot is $40, what about $10? And that's why you end up dividing the two.
Yeah. So PEEPs multiplied by that one, then you get that distance. So that's where maybe, for example, you're getting these 40. Yeah, $40. So then you're going to have that 8 or 10 divided by 40. And of course, this is a quarter or 0.25 lots.
Yeah.
And there we go. So that one was just to summarize, so things become clear at the end of it all, because we have started by explaining bit by bit right from the beginning. So it's just the stop loss PEEPs, no, the risk amount divided by stop loss PEEPs. But of course, you have to make sure that this, when you're converting this, when you multiply, you consider it to be, you take the PEEP value of one standard lot in this case, right?
Yeah.
Multiplied by the standard, the PEEP value of one standard lot, PEEP value of one lot for that given instrument. So if it is Euro USD, you have to know what is the PEEP value of one standard lot of Euro USD. If it is GBP, Euro GBP, you have to find it, and that's when you're going to get this value here.
I think that's what you alluded to in the previous slide, where you're talking about determining the PEEP value first. So it can be any quote. You need to know the PEEP value, and then from there, that's when you can proceed to do all these other calculations.
Exactly. If you have the position size calculator, things become even easier for you. And I want to clear everything so I can move next. Clear all drawings. Okay.
I think that's it in terms of calculations.
So that's it.
Yeah.
Wow, awesome. So it's always good that traders, you always premeditate the amount of loss which you're likely to suffer. Look at, before you look at the opportunity, consider what is the worst which can happen. And the worst which can happen, in this case when you're trading, it is the amount of loss that you're likely to suffer. If you don't consider that, then you are not really aware of the risk which you're facing in the market.
I think you have to consider and then accept it is possible, because at some time people usually have strategies assuming they're never going to be wrong, and then they have a hard time accepting that there are those events where, or those sessions where the trade simply doesn't work out, and that's a possibility when it comes to trading. So you need to accept that this is something I'm risking.
Yeah, another important thing that I want to mention, if you have got some very little amount in your account, risk management is going to be very hard for you. Yeah, because imagine if you've got a very small account, and if you try to do even a 5% 5% risk amount, it's something so small that if you try to fit in the stop loss within that risk amount, it doesn't make sense. Yeah. So again, a very little amount of money does not allow you to properly apply risk management.
Yeah,
that's my take. I don't know what's your view.
The lower the capital, generally you have to be accepting higher risk percent-wise, because you can only go until 0.01 lots at the end of the day. So at some point, you'll just have to use 0.01 lots as standard. And if your account is really small, then that might even be still bigger than the 2% threshold that you set for yourself per trade.
Yeah. So I think traders should avoid this. There's this idea where someone thinks, or a new trader thinks, that they are actually managing risk by putting in some very small amount of money. Yeah. Because you're avoiding to put a big amount of money and lose it. You see, at the end of it all, you put a very small amount of money, then risk management becomes tough. You'll have to again start putting another amount of money, where you could have just done a big deposit initially, and then you're able to apply a proper risk management. Yeah.
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 Yeah,
So
because
I
you
think,
wouldn't want something like tight stops that you're wicked out of the market,
yeah,
or those reasons where you can't really hold a trade because you're trying to have really tight stops because of the account size.
yeah. It's always good to have an amount that if you put a stop loss, then it can allow you to at least put in or factor in the aspect of volatility. You see, when there is volatility, you don't put your stop loss maybe so close to the swing high. If it was a swing high or swing low, you extend a little bit. So if you have some good amount of money, it can allow you to at least extend the stop loss or allow you to put the stop loss stretches a little bit further. And then, of course, you avoid what Sam is saying, being wicked out.
Yeah, I think if you go to the previous slide,
Mm-hmm.
the aspect
Here
of
we are.
volatility comes in
Mm-hmm.
on the number of pips.
Yeah.
So if the market is very volatile, then naturally you'll have a lot of pips to consider.
Sure. We're having a question here, Sam, and Kabu, welcome to the session, and thanks for being here. Kabu is asking, how much can I risk? How much can you risk? I mean, for me, it depends with it depends with the trader, but mostly you're advised to take a small percentage of risk, especially if you're beginning. Just take not more than 2%, but it's not fixed. You can extend it a little bit to maybe 5%. Yeah, but you realize you're only forced to extend that percentage if you've got a very small amount of money, because you're trying to not put a very tight stop loss. So if you have some good deposit in your account, even a 1% is something that you can work with. For example, if you do 1% of $1,000, how much is that? So it's around 10.
Yeah, it's around yeah,
Around 10.
around 10.
Around 10. Yeah. You see, you can even work with that, because if you, for example, you're targeting a reward of like 3 times reward, maybe $30, and you're putting a stop loss of 10, I mean, that's reasonable, right? But if you do 1% of $100, that's $1. Okay, already it's very tight. So you have to do like 3% to at least allow a $3 loss. You see?
Yeah. Because
So
you wouldn't want generally if you're seeing that the market is very volatile, you'd have to be extremely good if you want very tight stops. And in most cases, you have to give yourself some allowance.
Yeah.
Because your accuracy might reduce if you are putting very, very tight stop losses. And that's where the concept of giving your trade some room to breathe comes in. And if you're going to give yourself your trade some room to breathe, that means you'd have to consider in more pips in your calculation. And that's why your lot size will reduce, and all those things are factored in.
Yeah, sure. So I think we don't have many questions as well. I would just want to advise traders. This simple advice, as simple as it is, that is what you need. Put those things in practice, and you see there's going to be a change. Yeah. All right, Sam, you have something? Parting shot, maybe? That was my parting shot. How about you?
I think there's a difference between knowing how much you should risk and accepting it.
Oh.
Because it can be that you've accepted you're risking maybe $10. Are you really willing, if you were to see -8, -8.5, have you really settled the terms that it's a $10 risk, for example, and that's that? Like, so there's usually a big difference between knowing how much you should risk and actually accepting it. So you have to reconcile those two.
Yeah, you should not only calculate, but also make sure after you calculate and see the amount of risk, you accept it.
Yeah.
All right, thank you so much, our dear viewers and listeners. Let's meet next time. we speak about the markets. All the best. Bye. Good evening.